You have got to be kidding me. You got to be kidding. According to a report on TheStreet.com, Wall Street banks warned the midterms could delay the market structure bill until 2027. Guys, nothing about U.S. crypto regulation was repealed, reversed, or rejected, but the probability distribution around when market structure rules arrive just shifted. This is not a political headline. It is a calendar signal. So what happened? On January 5th, 2026, TD Cowen's Washington Research Group issued a note warning that the U.S. Digital Asset Market Structure Act could be delayed until 2027. The note was authored by the firm's managing director for policy research, Jarrett Seberg. The warning centered on the November 3rd, 2026 U.S. midterm elections. According to TD Cowen, even if the current administration pushes to advance the bill in 2026, political incentives may slow Senate progress ahead of the elections. The legislation is designed to establish a formal regulatory framework for digital assets and clarify jurisdiction between the Securities and Exchange Commission and the Commodity Futures Trading Commission. The House of Representatives passed its version of the bill in July 2025, alongside the CBDC Anti-Surveillance State Act, but no Senate vote has yet occurred. So how did this develop? Like, what happened? I thought this was coming, right? This market structure bill emerged from sustained regulatory ambiguity, because for more than a decade, U.S. crypto oversight has been enforced primarily through case-by-case actions rather than statute. Agencies relied on existing securities and commodities law. Jurisdiction was asserted after the fact. Market participants operated without a unified classification regime. The proposed legislation attempts to resolve this by defining which digital assets fall under securities law and which qualify as commodities. And that definition determines licensing requirements, disclosure rules, and enforcement authority. The bill advanced in 2025 amid broader federal crypto activity. And President Donald Trump even signed an executive order establishing a strategic Bitcoin reserve. Congress passed the Genius Act, creating a regulatory framework for U.S. dollar-pegged stablecoins. And together, these moves created an expectation of accelerated clarity. The market structure bill became the remaining pillar. So the bill's path is now constrained by the Senate, right? And the arithmetic and procedural requirements, they're hanging over our head. Even with full Republican support, passage is going to require Democratic votes to overcome Senate thresholds. And TD Cowen estimates at least 7 Democratic senators would need to vote in favor if Republicans remain completely unified. But if Republican support fractures, even just a little, that number increases. The central friction point is conflict of interest language. Democratic lawmakers have pushed for provisions restricting government officials and their families from owning or operating crypto businesses. And guys, we know Don Trump Jr. has American Bitcoin. And we know Barron Trump is sitting on a pile of crypto assets. You know the Democrats are probably holding strong because they think Trump is trying to just make his family prosper. And he might be. We don't know. Right? But the Republicans are trying to oppose immediate implementation of those provisions. Right? They don't think government officials and their families should be restricted from owning crypto businesses. So TD Cowen notes that such language would likely be unacceptable to the White House unless delayed for several years. And that delay mechanism introduces further legislative complexity. So there was no immediate legislative response following the TD Cowen note. No new amendments were introduced. No committee votes were scheduled in response. And markets did not price the warning as a binary event. Crypto prices during the period were influenced primarily by macroeconomic developments, including trade policy, interest rate expectations, and yes, even what was going on in Venezuela. Institutional positioning remained unchanged. ETF flows, custody activity, and exchange volumes showed continuity rather than disruption. What changed was not behavior, but the expectations around the timing. So if the legislation slips into 2027, the regulatory environment remains functional but incomplete. Agencies would continue operating under existing authority. Enforcement would remain selective and precedent driven. Clarity for token issuers, exchanges, and custodians would remain partial. If the bill passes in 2027 with a delayed effective date, implementation could extend out into 2029. Ouch. Not good. Not good. That sequencing would resolve political conflicts without altering near-term operations. Basically, have some elections, kick Trump out of office, then pass the crypto stuff. Right? But it does not eliminate the regulatory pressure. It postpones statutory consolidation. So the primary risk here is legislative fatigue. Extended timelines increase the probability of rewrites, dilution, or abandonment altogether. Election outcomes could shift committee leadership. Policy priorities could reorder. And another risk is regulatory drift. Absent statutory clarity, agencies may continue expanding enforcement interpretations independently. That path increases legal uncertainty rather than reducing it. There's also execution risk. Complex bills with delayed effective dates face higher implementation failure rates. So let's take a 30,000-foot view here. Why does this matter? This moment reflects a broader pattern. Digital asset regulation in the United States is no longer blocked by ideology. It's constrained by sequencing. The system is transitioning from ambiguity to structure, but on an institutional time. Markets tend to price outcomes. Institutions price timelines. And this warning was about alignment between political calendars and regulatory infrastructure. And right now, that alignment remains unresolved. So guys, nothing was halted, nothing was accelerated, but the window narrowed. And if this holds, the second order effects are structural, and we will break those down separately. For now, it's just wait and see. Guys, if you found value in this, if you're mad that these politicians can't get our stuff passed, hit like, hit subscribe. I'm going to keep you updated on what I know about the market structure bill, the Clarity Act, as things unfold. But for now, this is Ledger Prime.